Most people, me included, feel that 3.4%, that doesn't seem right. It feels like over the last number of years, inflation has just been so wild, and 3.4% doesn't really seem to fit our felt reality. Good morning. Welcome to Life in the Markets. My name is Tim Russell, and I'm joined by Stephen Rohr. Today is Monday, August 17th, 2027, and we here at the Life Group are excited to be able to work with Christian clients to help them become even better stewards of all of their assets. Today, we want to review what happened in the markets last week, and long story short, almost everything is looking positive and encouraging. A couple notable exceptions, but we'll get into that here. The S&P 500 largely flat on the week. It was up about a third of a percent. That puts it year to date at about 13% positive, 13.75% positive. The equal weighted S&P 500 had actually a fairly good week, up 1.2%, showing it continuing to outperform the larger cap companies in the S&P 500. That's looking very strong. The NASDAQ, it was up 1% for the week. Again, up about just shy of 24% for the year. Look at this next thing, the Russell 2000. This has been the most unloved index, it seems, over the last number of years. It hasn't done anything in terms of growth. It's keeping up with, in fact, surpassing, or just about surpassing, it's a neck and neck right now, with the NASDAQ. The Russell 2000's generally smaller, mid-cap size companies that are just, again, no one loves these companies. They're not growing in value very much. I like them. I think they've got a lot of potential. But year to date, they're actually showing some beautiful signs of life.
Even in spite of all of the AI fervor going on.
In spite of, maybe even in some ways because of.
Correct.
Or reaction to. Yeah.
Broadening out.
These are good trends. We love to see this. It's overall a good thing for the market to see all participants doing well, not just a handful of names. It's our biggest complaint from the last 2 or 3 years. It was just a handful of names that were doing spectacular, and everyone's like, the market is on fire. I'm like, no, it's just like 2 or 3 names. Everything else is fine. This year, it's a different story. It looks like most things are generally doing well this year. International market, flat for the week, 13% positive for the year. If we look at the commodities, gold was marginally higher. Silver was up about 2%. This was the negative one. It's positive. Oil is positive, almost 7%, but we all recognize that comes out of our pocket because we have to pay for that in the gas pump. So while it's positive, I kind of consider that a negative thing. We're up positive 43% on the price of oil year to date. Now, this is still a marked improvement from its highs where we were, what was 120% improvement or increase in the price of oil when Iran really took shape. Bitcoin was off. Bonds were off a little bit. The aggregate bonds were off. The high yield bonds were positive just so slightly. And the 10-year treasury, not surprisingly, if the ag is down, the 10-year treasury is up. You got it. All right. So where does that put us for the markets in general? The markets are robust. They're behaving strongly in spite of everyone's prediction of death and destruction of the stock market and the AI bringing a death knell for the markets. Honestly, their markets really don't care about your opinions. They're going to do what they're going to do. They don't care about my opinions either. Don't take it personally. The markets are doing better, honestly, than I expected that they would do this year. I'm grateful for it. I really am. So this week, one of the important updates that we got was a measurement of inflation, and that's usually reported through the CPI, that's the Consumer Price Index. And what the CPI tends to do is it gives us a measurement for how fast prices are increasing. And I will acknowledge this right on the outset. The number is that on the last year, prices have increased 3.4%. Now, here's the thing. Most people, me included, feel that doesn't seem right. It feels like over the last number of years, inflation has just been so wild. We have not seen any kind of price reductions, and 3.4% doesn't really seem to fit our felt reality. The reason that I think that's somewhat deceiving, allowing our feelings to drive this, is because we're sensing something that's accurate, right? Mm-hmm. Prices have gone up substantially since COVID. Prices of food, prices of homes, prices of everything. But why, when I say the prices are up 3.4, people are like, well, that doesn't feel like a lot. Well, I feel like it's a lot higher than that. Well, the reason for that is honestly because we've had so much increase over time. Correct. That even from this point, only a 3.4% increase feels like a lot. It does.
And the accumulated years of higher inflation.
Yes.
It all bakes in. So we're feeling the effects of 3 or 4 or 5 years of 3.5%, 4%. And
well, even that 1 year of about 9%, 10% right. Inflation. So yeah.
Yep.
When I look at the data, and I've got the chart here for us, all items was like 3.4. We look at food. Food was maybe 3.3. Look at energy, though. The energy inflation was nearly off the charts. It was about 15% for energy. That's wild. And then if you actually dig in and see what is going on in energy, it breaks it down into 2 different groups. We've got energy, the commodity, that's like oil that goes in the tanks to fuel your homes. Yeah. And then you've got energy services. Mm-hmm. Energy commodity was up, I'm going to say roughly 25, 24% over the past year. So clearly energy is the biggest contributor to inflation, which honestly with the inflation or the price of oil kind of fluctuating, it's really hard to get a good measurement of the actual impact of oil on everything because it's been high, it's been low, it's kind of been bouncing around. I feel like in another 3 to 6 months, we're going to have a better sense of the real, true, long-term impact of the price of oil in the regular cost of living. There's another measurement that came out last week, the core CPI, the core consumer price index. And what they do there is they strip out the cost of energy, they strip out the cost of food. Why? Because those things bounce around so much, just like I was saying. Right. So if we take those things away, everything else that we pay for, how is that looking? And honestly, it's a better picture. It's 2.5%. So it's nearly a full percentage point lower when we take out food and energy. So all you have to do to enjoy that is stop driving your cars and stop eating food. You'll be fine.
Simple.
Yeah, no problem. Yeah. No problems there. So anyway, all of that to say, the price of living is not cheap. This is one of the reasons why you have to continue to invest in equities to be able to have an opportunity to keep pace with inflation.
Right.
Let's talk for a moment about employment. What did we learn about the employment market in your research and studies?
Yeah, it was interesting. We just crossed over into a record period of low unemployment, or at least unemployment that is at or under 4.5%.
Yeah, it's remarkable.
4 years now that's been under that. And it makes us go back to 1970 to when that previous record was set.
Wow. It's remarkable. Wow.
So it's a pretty significant stretch. The problem is it's actually because people are leaving the workforce. It's not because there are so many jobs per se that have been created during that period. So that's kind of the downside of when we look into the actual data of what's going on there. However, there are some positive signs that the wind might be changing. The National Federation of Independent Businesses, NFIB, puts out a small business optimism index, and they just released July's data. So their optimism index rose from 97.4, which is already high, to an even higher 99.8. So it hasn't been this high since last August, and even better, their hiring plans increased 9 points month over month, with current job openings also increasing by 4 points. So again, some of this is their sentiment and their forecasting the next several months or year perhaps, but it is good that they are seeing that direction as far as where they are seeing opportunity for their business.
Yeah, anecdotally, I talked to a number of business owners, and honestly, most of them that I've talked to are actually really encouraged seeing their own businesses grow and improve in spite of all of the headwinds that we're facing. Mm-hmm. So take it for what it's worth. The anecdote doesn't make a trend, but it is my observation.
And I'm not too surprised that there's some benefit going on, that small businesses are feeling better because of some of the tax changes that President Trump put through last year. Some of those things were things that were going to help small businesses with capital expenditure and growth, and that's definitely a lagging effect. So I'd say that makes sense that there is starting to be a little more momentum.
Yeah, I think there's also been just a mood shift in the country.
That too.
And just the whole the craziness with all of the wokeness that takes the joy out of running a business when you've got to deal with such politics. And when you can get beyond all of the nonsense politics and just get down to what you're here for, delivering the service, delivering the product, and not worrying about, stepping on people's toes just because you misgender them. Right. Frankly, that's a refreshing thing. I wonder if you know where my sensibilities are on this matter.
Yeah.
Okay.
No, it turns out when you acknowledge reality that God has established, it actually clarifies things, and we can we can carry about our daily life much easier. In other news, $1.9 trillion Broadcom, which makes it one of the top 6 companies in the S&P 500, they shed some gains this week, dropped 6%. So there's a little bit of movement there, even in the big guys. Another big thing of note is that existing home sales continue to be near 30-year lows, with only 4.06 million annualized sales in July. I wondered what the 30-year comparison might reveal. So in 2026, the median home sales price is $410,000, while the median household income is about $83,000. So this is about 5 times the income, the median house price versus the median household income. Now, compare this with a median existing home price of $114,000 in 1996, or about $250,000 in today's dollars. This is while median household income in the United States in 1996 was only $35,000, or equivalent to roughly $71,000 in today's dollars. So this means that the home price in 1996 was only 3.5 times the household income. So that makes today's 5 times household income versus the 3.5 times in 1996. That's a 42% increase in home price versus income. So you combine that with a reasonably high interest rate, or not low, certainly, and it's no wonder that sales are around 30-year lows. However, most owners aren't needing to sell at this point, particularly if they were able to take advantage of the extremely low rates that were available during the COVID era. So you combine those two, and there's a lot of just general stalling out in the real estate sector right now. But however, you looked into some other things and found something interesting. Yeah,
one of the things that in my research was looking at bankruptcy filings, and the one thing that they generally say is that the consumer is strong. We see that overall, that lending standards are good, but we're seeing that delinquencies are starting to pick up. We're seeing that 90-day delinquencies in credit cards is tipping higher. Auto loans are tipping higher. Interestingly, the new 90-day delinquencies in student loans is actually dropping, so that's a good sign. But all of that is a leading indicator to bankruptcy and bankruptcy filings. And we're seeing that there's a sharp increase in the number of bankruptcies, both on the consumer and on the business side, both Chapter 7 and Chapter 11. And this is over the last 6 months of this year. And what that data is telling us is that a lot of consumers who are, we talk about this as a K-shaped recovery. So the ones who are doing really well, who have good income, their experience of this economy is just fantastic. They're happy. They're, go get them. No problems. However, if you're on the bottom half of the income spectrum, you're not able to deal with the increasing cost of living, the impact on your ability to buy the basic necessities is diminishing most of your cash supply. You're getting more debt, so there's a debt accumulation that's happening, and you just can't handle it. Therefore, we're going into bankruptcy. On the business side, we're seeing that it's not just caused by that. It's caused by the borrowing that took place during the COVID era with super low interest rates. Usually those are they're amortized out on 15-year loans, but they need to be recast every 5 years, which means you have to refinance and redo the loan. And they're not as strong financially. They're dealing, who knows, maybe with some tariff issues, some consumer sentiment issues and consumer demand issues. And at the same time, higher interest rates on refinancing, worse terms for refinancing the loans, forcing businesses to go in towards bankruptcy. So this is a concerning trend that we want to keep an eye on and continue to report to you as we see things develop. The best thing that you can do to avoid being a bankruptcy statistic is operate on margin. What I mean by that is not borrow money. I mean live on cash. Have a margin in your income so that your income is more than your spending. That you have money that you can keep in reserves. So that means having forced savings. Save before you spend. If you don't do that, you're going to spend it all, not have anything left, and you may have to go into bankruptcy when you borrow money and get out over your skis. So be careful with your borrowing, have adequate cash reserves. This is a way to avoid bankruptcy.
Now, that is always an important reminder. And it reminds me of U of M came out with their findings, consumer confidence, and a lot of people were feeling that their income is not going to increase enough to keep up with inflation.
Well, that's exactly the same thing that we've been talking about before, where consumer spending habits shows one thing. Right. Consumers saying about how they're feeling about what they're doing is an absolute opposite thing. Right. So consumers spend like there's no tomorrow, there's no concern about tomorrow. But when they talk to surveyors, they're very worried. Mm-hmm. So that's another alarming statistic. If they keep on spending when they're worried, that's not going to end well.
Right. And on that note, for consumer spending, we can kind of move into what we can look for going ahead this week and kind of later in the months ahead. On the consumer spending, major retailers will be announcing their Q2 earnings and results this week, so including Walmart, Target, Home Depot, etc.
Yeah, it should be a good read on what's going on in the life of the average consumer.
Mm-hmm. Yeah. And also this Wednesday, the Federal Open Markets Committee will release their minutes from July. Mm-hmm. And it'll be interesting to see how they're discussing and thinking about just interest rates and some of the other interesting data that's come out in July.
Yes.
Otherwise, there are some things that aren't happening this week, but some news that came out that will be playing out over the next few months. The social media behemoth Reddit announced on Friday that it is pursuing an IPO, and their share price started to climb again after being kind of depressed for a little while after the news broke on Friday. The massive AI player, Anthropic, is also preparing to go public in October.
Yeah, that and OpenAI.
Yep.
Yeah.
So those are going to be big ones. Potentially, if the valuation continues as it's currently standing, Anthropic could take the record from SpaceX for the largest IPO valuation of $2 trillion.
Yeah, Anthropic is the company behind Claude. So it's an AI company. OpenAI is the company behind ChatGPT. All of these companies coming to the market, again, shows us how excited people are to get into the AI race. But each one of these companies is expected to be an over $1 trillion IPO, which is bananas. So we're seeing a lot of IPO activity. This is usually a sign where we're getting to top end of a market where we see a lot of IPOs come into the market. Again, that's not a prediction. That's just historic observation. We still believe that, especially because of AI, this market could have some legs to run. As we wrap up today, let's talk about the verse of the week. The verse of the week comes from Proverbs 13, verse 11, and it says this: wealth gained hastily will dwindle, but whoever gains little by little will increase it. Slow and steady wins the race. You don't need to do it all overnight. You do not need to win the lottery to be successful financially. You do not need to rob a bank. Be slow and methodical and patient. Keep on doing what God has set before you. He who is faithful in little will be faithful in much. Until next time, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.